Right or things return. A right or things return is an elective return which can be filed for a deceased taxpayer. Incomes which will qualify to be reported on right of things returns are amounts which were due to the taxpayer while he was alive, but they were only paid after the date of death. Now let's assume that John, 68 years old, still working, passed away on June 15th. His employer owed him a salary for the pay period which was paid on June 20th. His employer owed him vacation pay which was paid on June 20th. His employer had announced a bonus which was paid on June 20th. So all these amounts from employer were paid after the death of John. These amounts will qualify to be reported on second T1 general return called right or things. Now we also said that John is 68 years old. He was receiving Canada Pension Plan and Old Age Security. These pensions are always paid at the end of the month, but John passed away on June 15th. So the pensions for the month that he passed away will qualify as the right or things amounts and can be filed on second T1 general return. And there are various other things such as dividends declared, but they were only paid after the date of death. So all amounts which were owed to the taxpayer while he was alive, but they were only paid after the date of death, will qualify as the right or things return. Now, right or things return is a second T1 general return. And we would file it for a deceased taxpayer because we are allowed all non-refundable credits to be reported all over again on second return. These non-refundables are basic personal amount, age amount, spousal amounts, amount for eligible dependent, and so forth. And these amounts are not prorated, so we are allowed full credits. By doing a second return called right or things return, and by claiming non-refundable credits all over again, we can reduce tax liability for the estate. So that's the benefit of filing a second T1 general return called right or things return.